Hey everybody, welcome to the Financial Freedom Show. My name is Rob Berger. This is the live Q&A version that we hold every Thursday morning at 11 a.m. if, weather permitting. And starting it actually a few minutes early to give folks a chance to join the chat. If you're watching live, say hello in the chat. Tell me, something about yourself, where you're from. If you're an Ohio State Buckeye fan. We did beat Minnesota, but I got to give a lot of credit to Minnesota. They played a great game, had a terrible injury. And frankly, I don't know. Ohio State didn't play that well. Anyway, if you're watching this video long after it went live and you want to know about Social Security and how to calculate it and how it can make you a millionaire, we're going to talk about that in about 3 minutes. And then, so you can fast forward to that if you want. I'll put timestamps below the video as well once the live stream is over. So we're going to look at Social Security benefits briefly. I've got a free calculator I'm going to show you that can estimate the current value of your future benefits. And then we're going to jump into the Q&A, whatever you guys got for me. I do have a couple of questions that folks have emailed me, at least one, that I'm going to share with you. So we're going to do that, and then whatever you got. Markets today are actually up, which was kind of a surprise because pre-market they were down. The S&P's up 23 basis points. And it's pretty flat for the most part. Banks are up. My Wells Fargo stock is up, but it was brutalized last week. That happens. All right. I've got Piyush. I'm sure I just butchered that name. You can tell me if I'm even close. Vinyl is back. He says, hi, suggest you post the chats in advance so we can schedule them. Okay, I'll have to figure out how to do that. Felix from Kenya. Yeah, I'm still working on the content that would help non-US investors. The reason I've not come out with any is because it's not something I have experience with. So I need to kind of figure out what the questions are, I guess, and if I can come up with any sort of helpful, useful answers to them. I mean, one thing would be good to know is, like, what are the biggest struggles you have as someone investing outside the United States? Trevor from the middle of Illinois. He says, love your videos, thank you. I've driven through Illinois many times. I've stayed there once or twice. Well, I guess I've been to Chicago countless times because the firm I work for, Winston & Strawn, is headquartered in Chicago. Greetings from Spain, nice. Someone from West Virginia, Mike. Yeah, I've driven through Morgantown many, many times. Ethan from Delaware, that's where I was married. Ethan, if you drive up 95, you're going north from Maryland into Delaware, there's a giant green building on the right. You know what I'm talking about? It used to be ICI Pharmaceuticals, or actually back in the day it was Stewart Pharmaceuticals. I worked there before law school. That was in 1988. All right. Piyush says, would appreciate if you advise on what you are investing in. Just the fund names, stock names. Yeah, you know what? We'll get to that. Absolutely. All right. I'm actually a minute past, so I want to dive in. I want to dive into this question. Here's how it came up. I did a video just a couple of days ago on how I think guaranteed income should, like Social Security or pension or annuity, how you should use that, how it should influence your asset allocation once you're in retirement. My view is it should have sort of an indirect influence, meaning you'll obviously, whatever income you need, let's say just to make a number nice and round, let's say you need 100 grand a year. Yeah, it's a lot of money, but let's just say you need 100 grand a year. And from guaranteed income sources like Social Security and pensions or whatever, you've got, 40 grand. Well, that means you still need $60,000 from your investments. And it seems to me that that's how you should figure out what your asset allocation should be. Because if that 60 grand turns out to be somewhere near call it 4.5% of your investments in year one of retirement, then all of the studies I've read tell me my asset allocation needs to be somewhere between 50 and 75% stocks. It's great that I've got this guaranteed income, but I still need 60 grand from my portfolio, and with those assumptions, that's kind of going to dictate my asset allocation. On the other hand, if 60 grand turns out to only be 1 or 2% of your portfolio, then you've got a lot more flexibility. Frankly, you could almost invest in just about any stock bond mix at those levels and probably be okay. But I know some of you would prefer to sort of calculate the present value of your Social Security and treat it like part of your bond allocation. And that's certainly a way to go. It's not the way I'm going to do it, but we don't all live life the same way. So I want to show you first an article, and I actually left these in the links to the video, but you can just Google it. What's your Social Security benefit worth? It's by William Baldwin. I don't know Bill personally. I know of him. He used to be the editor, I think the managing editor of Forbes, if I'm not mistaken. Extremely sharp guy. And he talks about this calculator, and it's in a spreadsheet, and there's a link to it, but I'll show it to you. But I recommend you read the article. And then here's the calculator. Now, when you go to it, you'll notice it's view only. If you click this, it says request edit access. Please do not do that. He will not give you access to edit this. This is the template, right? We need to keep it just the way it is. So instead, go to File, make a copy. There you go. It's that simple. And there it is. And now you've got your own copy, and you can do whatever you want with it. And so it's pretty straightforward. Basically, you can change the data in the blue boxes, and the yellow boxes spit out the answers. So the calculator includes estimating the value for a married couple, and then down here for a single. And so what you do is you figure out what your estimated benefits are going to be, and you can do that directly from the Social Security Administration. Of course, you've got your age and your gender. Mortality adjustments, and he describes this in more detail if we scroll all the way down. There's sort of some of the instructions which I recommend you read. But he says, it's right, let me see if I can highlight this a little better. It's right here. Healthy people can make the mortality adjustment actually a negative number, -5%. Smokers and people with COVID issues, and I say COVID issues because I tried pronouncing that word and I just wouldn't come out. But I got diabetes and hypertension. Anyway, the point is, if you got, I'm in one of those moods today. If you got health issues, he suggests a plus 70, and he's put in his hypothetical both, and then it spits out a current value. One, if you get your benefits as soon as you can, and there's an explanation of that. And then if you delay benefits, so you wouldn't want it, the most you would delay is right now is until you're age 70. And so if these numbers up here change, or the age changes, or let's say this person's really healthy, should change see the numbers change. So as you change things here, it's going to change the present value. The thing that might surprise some folks is that the present value of your benefits, particularly for couples, could easily be 7 figures, easily. And even singles, that ain't a small number. So there you go. I'm always here trying to give you guys as much useful stuff as I can. And there's a free calculator. So hopefully it's useful to you. Even if you don't want to turn your Social Security into bond portion of your asset allocation, it still might be a useful tool to check out. There you go. That was quick. Want to run by 2 questions real quick that folks sent in, and then I'll get to your questions. The first one is this, and let me show you here on the screen. This is Portfolio Visualizer. Someone sent in a question about QYLD, and it's a covered call ETF. I've gotten 3 or 4 different questions about covered call ETFs. So these are ETFs, they like this one. Put my ugly mug there. And actually, I'll move it over here. There we go. So like this one, the covered call ETFs that I've seen track some kind of index. This one's the NASDAQ 100. But what they do is they sell covered calls, which is, so they're selling to someone else the right to buy shares of something, right? In this case, it's the NASDAQ 100. Typically what I've seen are covered calls that are sold at the money, meaning the strike price is the same as the current price of the underlying security, and usually on a sort of rolling 4-week basis. I'm sure there are all kinds of variations to that. But these funds generate tremendous amounts of income. We're talking like 10% yield. In fact, I'm going to scroll all the way down. I compared it, by the way, to the QQQ, right? Because they're very similar, except this doesn't sell covered calls. Look at the income. The blue is from the covered call ETF. I mean, it's, and again, the reason the income is so high is because in addition to whatever dividends the fund generates, you're getting the premiums generated from the sale of the covered calls, right? And I know some folks love their income, but I keep stressing that what matters is total return, and I want to show you why. So what I did in this, let me just show you real quick. I started with $1 million. I did this from a retiree's perspective. We're going to take out 4% or 40 grand a year, adjusted for inflation. Because of limitations on the data, I think it only goes back to 2014. That's just what we have, so 7 years. Not a lot, but whatever. And look at the ending balances. The covered call ends up at 1.5 million. The QQQ at 3.8. They're both taking out the same amount of money, and the covered call ETF is getting, whatever, goodness, 8-9 times more income. But the total, but it's losing from a total return perspective. So you end up with a truckload more of money if you just invested in the QQQ. So I guess it's just another way to stress. I love my dividends, but at the end of the day, what matters is total return. Anyway, that's my view. All right, that's the first question I wanted to cover. The second one, real quick. This came from Mark. He said, question for your Thursday Q&A show. Rob, like you, my wife and I funded an HSA account. We don't touch it, saving for retirement, health expenses in retirement. It's been invested in the total stock market index. He said, I recently listened to a Morningstar podcast called The Long View, Michael Falk, Retirement Planning Can Be Done More Simply. In it, the guest stated, in your HSA, if you have one of your health care, why not invest in your HSA money in health-related stocks so that over time, as there may be inflation in the cost of health care, you get the benefits with the investments in your HSA to cover those costs. What do you think of that idea versus just sticking to the total stock market index? And if you like the idea, what do you think of using FHLC, which is a ticker, as a fund? Well, personally, I don't like the idea. I get the logic behind it. The logic is healthcare, the inflation on health-related costs seems to be different than other things. And by different, I mean, the costs seem to go through the roof, right? I mean, they seem to rise faster than the CPI, let's say. I don't have any data, by the way, to point to. I guess I could have researched it, but that certainly is my impression. So I guess the theory is because those healthcare costs go up at a greater rate, the stocks of healthcare companies will also go up, if nothing else, because of this inflation in prices for healthcare, will also go up, presumably faster than the overall market. That's sort of the theory, I think. And the problem is I just don't have any confidence that that's in fact what will happen. And it's hard for me to believe in any event that healthcare stocks will significantly outperform the market as a whole over the long term. And even if they did, there's going to be periods where they significantly underperform. That's just the nature of the beast. So I don't know. I just don't see personally a need to do that. In terms of FHLC, I know nothing about it. Let me pull up this on we're going to go to Morningstar so we can look at it together. A 4-star fund. It's got a yield of 117. Adjusted expense ratio is just a little over 8 basis points. I assume it just invests in a bunch of, it's basically the healthcare sector. So this could be a perfectly good fund. It's not expensive. Its big stocks are right here. I don't know how well you guys can see that. Let me make it a little bigger. Johnson & Johnson, United Health Group, Pfizer, Abbott, Eli Lilly, Merck. I mean, these are all, for the most part, well-known companies. Could be a great fund. I would just personally, I guess I just don't see a need just because I'm going to use this for healthcare. I guess there's two things. I don't have confidence that there's a relationship that this person is suggesting between the cost of healthcare and how healthcare stocks will perform. Maybe there is. and I'm missing it. It'd be interesting to look at the data, but without that, I'm just not going to be one that jumps on that bandwagon personally. That's my take. All right, there you go. Now it's your turn. What are you investing in? Well, so in terms of my stock portfolio, it's just 4 companies: Apple, Berkshire, Bank of America, and Wells Fargo. One thing I'll say about stocks, you may look at what other people own, other famous investors, what Berkshire Hathaway owns, Warren Buffett. The thing, though, to keep in mind is that it's not just what you own, but when you bought it, right? So I've bought Apple stock 3 different times. The most recent was in early 2019, so I haven't bought any since then. And I got it at prices that were relatively low. Well, yeah, relatively low compared to today. My first purchase was in 2013. I think on a split adjusted basis, I think I paid $15. It was when it was trading at over 700. It had a bad quarter, and it dropped like to 390 or something. And that's when I first bought it. So it's not just what you own, but when you bought it. But that's my stock portfolio. For my, I'm going to see, I started to create an M1. I think didn't I create an M1 Finance pie? I'm going to log into my account. You think I would just know this, but here we go. Yeah. Okay, let me show you this. I can leave a link to this below the video, but this is basically my portfolio. I say basically because I don't actually own any ETFs. But in M1, I've got to use the ETF versions, but that's fine. I mean, these are basically the exact same thing. I just have mutual fund versions. But I have an all-world fund. The reason, if you look at these two and you say, well, wait a minute, why do you have both of these? And it's because they were just in different accounts, and like I may have a 401k and I have to use what the options in the 401k. I have an emerging market fund, intermediate term bonds, a REIT. I have small cap. I like small cap value a lot, but at some point I'm just trying to simplify things. I have a small cap fund, VTI, a short-term treasury fund, a different. I'm trying to think why. Again, I have 2 different small cap. Oh, this is small cap value. That's right. So in one fund, I have a small amount of small cap value, and then Wells Fargo. So it's basically what I've described as a 6-fund portfolio. The reason it looks, the reason it's more than 6 funds is, again, because I have different accounts like HSAs and 401ks where I don't have the same investing options, and I kind of have to figure it out, as best I can in terms of what's offered. But it doesn't look like the 6-fund portfolio. But that's effectively what it is. VTI, international bond funds, and then I've added emerging markets, small caps, and REITs. I've talked about simplifying it, and I probably will, meaning I might get rid of the REITs and the small cap and just use like a VTI, which has both, but just in smaller amounts. A part of that is an age thing. Part of it is just trying to simplify my portfolio. But I don't make these decisions lightly, so I've been mulling that decision for months, and I might keep mulling it for a while. All right. So John, okay, back to your question. So that was the answer. That's what I invest in. So, I do invest the way the videos that I have about my view of investing is pretty much how I live. And by the way, how I invest would be no different if I had $100 million. This idea that when you have more money, you need to have all these different kinds of investments, I just don't understand that thinking at all. Jonathan, checking in, curious but suspicious that Social Security will make that much of a difference to a 32-year-old from Arkansas. Yeah, I get that. There's no doubt there are going to be a lot of changes in Social Security over the next, what would that be, 35 years maybe for you? And from a planning perspective, I would not count on it. That being said, if I were, going to make a wager, I would say that Social Security in some form will exist as far into the future in the United States as we can imagine, simply because politically it would be suicide to try to get rid of it. Now, there could be all kinds of changes to it. They could means test it. The ages for full retirement and all that could keep going up. They could increase, the taxes on the payroll tax side. So all kinds of changes could happen. I can't imagine them getting rid of it completely with that, or I can see them maybe replacing it with something new, but it's hard to imagine them just getting rid of it. But from a planning perspective, Jonathan, I kind of agree. I wouldn't rely on it. Frank from VA says, from Virginia says, morning, Rob. Federal employee retiring next year. My plan to defer Social Security until full retirement age, 67, by taking more than the recommended 4% from 60 to 67. So that's an interesting comment, Frank. And I don't know if you were the one that emailed me. Someone emailed me that scenario. It may have been you. And I've got it in my notes to do a video on it. But here's the idea. If we assume that 4, maybe 4.5% is the most you can take out in year 1 of retirement and then adjusted for inflation following Bill Bengen's 4% rule. Well, what if you're going to retire like Frank is, it's, say 60, can you take out more, like whatever, 5.5%, 6%, some higher number? Because that when you hit 67, Social Security, or it could be a pension, or it could be whatever, but some kind of guaranteed income is going to come in, and it will allow you to then bring that number back down. You won't have to rely on your investments as much, and so whatever, that 6% comes back down to 4 or 3.5 or whatever it is. And I think conceptually that makes all kinds of sense to me. I think if I were in that situation, I would use a tool like Personal Capital. It doesn't have to be Personal Capital. And there are other retirement calculators, by the way. What I plan to do is a video where I start with some assumptions and put them through a number of different retirement calculators and see if they come up with different answers. So you might use multiple calculators, but I would model this. And so Personal Capital makes it easy, right? I mean, and I think I've shown you guys this, but I can show you again. But because you can put into Personal Capital all these assumptions when you're going to retire, in this case 60, how much you're going to take out, your spending, when you're going to take Social Security. So I'm logging into this account here real quick, and I'll just show you. So this is the demo Personal Capital thing that I've shown you before, retirement planner. I think I may even have this plugged in. Yeah. So like here's someone that's going to retire at 67, and they're going to get Social Security at 67, but we can edit these assumptions. Whoops, edit the profile. So let's say I'm only 60. So what is that? I wasn't born in the 1600s. Let's try this. How old does that make me? 61? That's close enough. So I'm 61. You can see that right up here. And I'm going to get Social Security at 60. Let's get rid of the rental income. The savings is just pulling from the sort of demo investment portfolios I've put in. And so we can change this retirement spending, right? And what you can do is, let's see here. So I'm going to start this at 61 in this example, right? And then let's save that. Now I think, so that gives us a 74% chance. Now the one thing I don't know if you can do, I think I can do, if I do another expense per year, let's say it's, no, that's not how I want to do it. I'm trying to think how I'd model this. Yeah, this might not actually be the best tool because, oh, I see. Well, I can decrease it. So what I could effectively do is I'm going to have to spend more time on this. This is starting at age 65, and I don't think I can change that. So this may not actually be the best tool. All right, I'm going to have to come back to that, Frank. I'm going to come up with a tool that can model this. I think this can help in some ways. What I'm trying to figure out is, because effectively what I want to do, maybe this is just the best way to do it. I'm kind of surprised that it only has a 74% chance, given I'm only taking, to begin with, 120,000 out, which is roughly 4%, because in your scenario, you might take out, again, we're just thinking about it in percentages, something higher than that, right? But I guess this would still model it. Your spending's not going to change, just Social Security is going to kick in, but I'm surprised at this number. This is what I can't figure out, why that number is so small, given that, you've got this Social Security here. So I guess this actually does model it correctly. I just don't understand the 31%. I'll see if I can find some other calculators that maybe do I don't know, a better job, but I'll have to spend some more time studying that. I'm not sure why it's 31%. All right, what else we got? Fast Eddie's back from Fort Worth. Felix, thank you for the kind words. You too, Jim, from Los Angeles. Okay, so Dave from Lexington. Per your video on dividends, isn't there a tax advantage for taking dividends versus capital gains from selling stocks? Well, I'm not sure exactly what you mean. If you're retired, I guess even if you're not, if you want to spend some of your investments and they've generated, and we're assuming a taxable account, and they've generated dividends, that's going to be taxable income, whether you spend them or not, right? You could leave them in the, if you automatically reinvest them, or if they go to a money market fund, either way, they're going to get taxed. And so if you're going to spend them, spend something out of your portfolio, it makes sense to spend the dividends since they're already going to be taxed, rather than leaving them in and selling shares that will also generate taxable income. So yeah, if I understand your question right, and tell me if I've missed it, but like in my case, the first thing we'll spend if we need to take money from our investments are dividends and interest from taxable accounts, because they're going to get taxed anyway. So absolutely. Yep. James, hello. He's in Leesburg, not far from me. Frank from Hoover, Alabama. Austin from Philly. I grew up in Ohio, but the Sixers were my favorite basketball team. I think it's just because of Dr. J. I remember playing basketball with my son. We're shooting hoops, and he did some move, and I said, "You look just like Dr. J." And he said, "Who?" I said, no, this is not going to stand in my home. Mm-mm. So we went right to YouTube. He now knows who Dr. J is. So James asks, how should you withdraw from a traditional IRA? Monthly, quarterly, twice a year? Well, I'm trying to think why it would matter. I mean, if you have RMDs, if you have required minimum distributions, you can choose. I don't know what different, payment methods they offer. I think certainly annually. I think they offer monthly. Maybe they offer quarterly. But if you're just withdrawing, you're whatever 59 and a half or older, and you just want to take money out, I'm not sure it matters. I mean, I suppose one could argue if you want to keep as much money invested as possible, you'd take money out monthly. But to me, it comes down to more of a convenience, simplicity kind of question. I can't think of why it would matter otherwise. If anyone can, let me know in the chat. Trevor, since we were talking about Social Security, what's your take? Take out Social Security early and invest it yourself, or take Social Security at 70 and be happy with a bigger paycheck? Well, so a lot of that depends on your specific circumstances. And are you married or not? And one theory is for the lower income spouse to take it earlier and the higher income spouse to wait. I am not a Social Security expert. When we get to that point, I'm going to pay a couple $100 and have someone tell me the answer. I mean, there are Social Security experts, and I've interviewed some back in the day. So there are different ways to take it. I can tell you, in my case, I will definitely defer until 70, and the reason is just it's we don't need the money before then. And of course, it'll be, as you point out, it'll be a bigger paycheck. And so in some sense, it's a longevity insurance. I kind of see it as money that's going to come in, that's going to be maybe important should we live longer than average or longer than we expect. But when you get to that point, I would definitely recommend spending a few $100 to get someone to analyze it for you. They have tools that will do it. And I might be able to find some resources on that. But All right. Whoops. All right, what do we got? Stuart says, Social Security at 70 is something I'm seriously considering as a hedge against inflation and risk to our portfolio. You know, that's a good point. I mean, Social Security is adjusted for inflation. So, you know, that's a huge benefit. You know, you can't today buy an annuity that adjusts for inflation. They don't exist. I don't know if that's changed. My latest research shows they don't exist. You can find some that might adjust like 2% a year. By the way, and it turns out that when you could buy them, I think the last one that I know of that had an inflation adjustment, I think they stopped selling it in 2019, but they turned out to be a bad deal anyway because the costs were just too high. But Social Security adjusts for inflation. All right, Roger from San Francisco, hello. Love San Francisco. Jeff, enjoy your channel and always learn something. Thank you. Joanne, welcome. Thank you. Vinyl, by the way, I hope Vinyl One Earthlink doesn't mind that I just shortened his or her name to Vinyl. Yeah, leveraged covered call ETFs are junk bonds. What could possibly go wrong? Yeah, I didn't realize they were leveraged. I guess some of them might be. Yeah. What else we got? Austin says, Rob, do you follow factor investing? Do you think that the benefits are still as strong since Fama French published their findings? Or do you think it's just priced in now? Well, I don't follow it from, I don't invest in like factor ETFs or whatever. I mean, you know, one could argue that a 6-fund portfolio is factor investing in a way, right? Because we're tilting our portfolio based on certain factors like the size of a company, value versus growth. But here's the question. I think any of these things, if they're not expensive, can be okay if you stick with it. That's the thing that people, I think, miss. You know, when you talk about asset allocation, how much should you have in stocks? How much do you have in bonds? You know, should you do a 6-fund portfolio or something else? Probably the single most important question is, whatever you decide, can you just stick with it for 40 years? And I think the more you sort of slice and dice and factor and kind of get too cute, I don't know if that's the right word, with your investing, I think the harder it is to stick with it. Because there will be bad times. I mean, there'll be bad times no matter what we do, right? Mike says, any thoughts on WEP? Well, Mike, unless that's a ticker, I have no idea what that is. Is that Web Solutions Limited? You'll have to let me know. But if it is, no, I've never heard of it. And if it's something else, then you'll just have to let me know. Oh, here's a good question from Kevin. Do you see an issue with having more than 500 grand in a single brokerage account, specifically Schwab and TD Ameritrade? It is my understanding they have coverage beyond the SIPC 500,000 insurance. Well, it's interesting. I don't know what the coverage limits are, if there's a way to get more than that. My concern is a little different. And it's not specific to 500 grand. I mean, what if you have 10 million? I mean, you know, I guess you could open up 20 brokerage accounts, but to me, the question is a hacker. You know, someone stealing your password. I don't know, you know, you have one thing, you got to have 2-factor authentication on all your accounts. You just have to. And there's other things you should do. You should use a password manager. In fact, I'm working on a video on all of this. But there is part of me that thinks I don't want to consolidate all my investments in a single broker just for that reason. It's not so much the insurance issue, particularly if you're dealing with a broker like Fidelity or, you know, Schwab, TD Ameritrade, Vanguard. I'm more concerned, you know, with some sort of hacking situation. And so we have our investments in 3 different brokerages. Well, yeah, 3. I don't know that that's necessary, but you know, if you're retired and you got a couple $1 million or whatever, having it all, I mean, there's a convenience factor, right? If you have it all in one, but that makes me a little nervous. So Vinyl says, total return is not total return until you sell, whereas dividends are cash in your bank account. Yeah, I hear you. But if you think about it from a retirement perspective, you're going to be selling gradually over 3 decades. And so you're going to be rebalancing. So if the market's down, you'll be selling bonds to buy stocks. And so I've yet to see a portfolio that's heavily tilted towards income. If you have some dividend paying ETFs or whatever, that's fine. It's not, you're not deviating from the market significantly. But I see all these YouTube videos about 7 dividend stocks to buy now, and covered calls so you can turn your non-dividend paying stocks into dividend payers, which you can't because they ain't, but whatever. Total return to me is what you need to focus on. The problem actually is this: we have it in our minds that it's better to get a dividend than to sell a share, and it's just not. You've got a pie. It's so big. No matter how many pieces you cut into it, it's still a pie. You've got $1 million. It's $1 million. I don't care how many shares it takes for that $1 million. You have $1 million. And if you take money out, if you take 50 grand out, you're taking 50 grand out. And I've shown you how when a dividend is paid, the price goes down. And people point out, well, yeah, but the next day the price can go up. And I think they miss, and that's true. I mean, because the dividend is a relatively small amount compared to the price of a stock typically. If it's a 2% yield and they're paying out quarterly, it's only a 0.5% coming off the price, and the stock can easily go up or down by more than that in a day. But if you look at the balance sheets and how their profits are used, and you see the billions of dollars being paid out in share buybacks, which is another way to return value to investors, and dividends, I don't know how anyone can conclude that the intrinsic value of a company hasn't changed when they pay a dividend. It has changed. Now, the market may not reflect that tomorrow, but it will reflect it eventually, right? That's why Warren Buffett says the stock market is a voting machine in the short term and a weighing machine in the long term. In the short term, all kinds of craziness can affect the price of a security, but in the long term, it's cash flow, earnings. Anyway, so I'm still sticking to my total returns. What else we got here? Jeffrey, good morning from Liberty Hill, Texas. Greatly appreciate your videos. Welcome, Jeffrey. Todd wants to know about QYLD, which I just looked at. I don't remember why. Why did I look at this? I'm going to pull it up. Give me a second. Well, Google is not cooperating. Wait a minute, for bond? That's the covered call ETF. I don't understand that. That's not a bond. So, yeah, I mean, if you look at, yeah, I mean, I understand. I guess your point is it generates a lot of income, which it does because it sells covered calls. But, let me just show you this. Here's its standard deviation, 14. That's its volatility, right? Now let's compare that to Vanguard's total bond market, which is by no means the least volatile bond fund that you can get, because it's intermediate term and it's not all U.S. government. Its standard deviation is 3.66. So, yeah, I wouldn't personally. I would not even consider a covered call ETF as for my bond allocation. It doesn't behave like a bond. Doesn't look like a bond. It generates a lot of income, but frankly, you could just invest directly in the underlying security without the covered call nonsense, and you'd do better. Frank says, I have debated switching from your 6-fund portfolio to 3 funds. Well, as you know, I've been thinking about the same thing. How valuable are the extra 3 factors? I have 10% REITs, but is the extra sector exposure worth it? Well, here's the short answer. The short answer is in some time periods it will be, in some time periods it won't be. Will it be over your time period or mine or for the next 10 or 20 or 30 years? There's no way to know. So you have to make the decision based on something other than whether it will be worth it or not, because we don't know whether it'll be worth it or not. There's no way to know. We can back test it. And again, some back test, depending on what period you pick, will show an advantage. You could certainly make a sort of a conceptual argument one way or another. You're more diversified, kind of. REITs, maybe they do well in inflationary periods, some would argue, and we might be moving into that. With the total stock market, you've already got probably 2.5% in REITs. This would add more. But at the end of the day, I think what matters is, again, I go back to which plan are you more likely to stick with? And some people need those extra factors. It's just too interesting. That was me, for many, many years. I wanted that extra potential overperformance. So I had small cap value. I had micro cap at one point. But today it just is, it's kind of lost its appeal, and I'm slowly probably moving to 3-fund, but it's very slow. And it will be very slow because my small cap is in a taxable account and it's got a lot of gains, so I won't be selling it anytime soon. So Frank says, Rob, thanks for all you do. I can't decide between VTI VXUS, so VTI's total stock market ETF, Vanguard. VXUS is a Vanguard International, it's a really global fund excluding, that's what the X means, excluding US, or just VT. So VT is basically a combination of those two all in one fund. And he says, any thoughts? Well, it comes down, I think, primarily to whether you want to have control over the allocation between the US fund and the international. If you pick VT, and I can show it to you here, let's pull it up on the screen. If you pick VT, you're basically going with about, I want to say 57% US stocks. See how close I am. Yeah, 57.61 US and 42 and change non-US. So I mean, if that's the allocation you want, then it's perfect. I personally, I don't like that much in non-US equity. I'm not a Jack Bogle who said don't invest in international. I'm around, I want to say I'm around 20% roughly. And I like that extra diversity, even though international stocks have lagged US indexes in the recent times. But for me personally, that's just too much non-US equity. You've got to deal with currency issues potentially. Funds can hedge that. I don't know what VT does. The regulatory environments in a lot of these countries are not great. Look what's going on in China right now. I just read that if I read this correctly, maybe it's fake news, but kids can now only play games 3 hours a week. Did you guys read that? It's like, I'm not even sure, how do they even enforce that? But in any event, so that's my take on it. It really depends on the split you want between US and international. VT is not for me, but if you like that split, it's convenient. Vinyl says maybe the huge rise in health costs are already priced into healthcare stocks. That might be. The thing is that the performance of a company depends on so many things other than just inflation. Anyway, what else we got? Vinyl says a buddy who bought Apple in 2004 has a basis of 25 cents on 400,000 shares. Oh my word. He should be hosting this show. Thomas says, would you buy Apple stock today? If not, maybe you should sell your Apple stock. So that's always an interesting question. I'm not convinced that whether you would buy it today dictates whether you should sell it today. For a host of reasons. One is, I might not buy it today because it already represents a pretty large portion of my portfolio, and I just don't want to add more exposure to one stock, which is true. Now, I suppose someone could say, okay, but what if it didn't? Would you buy it today? Well, I could decide that it's reasonably priced, but I'm looking for something that's better than that. So I wouldn't buy it today. I want to find something that's undervalued. If anything like that exists in the current market, it may not, right? But because of that, it doesn't necessarily mean I'm going to go out and sell it. So I've sold. So we tend to donate appreciated stock through Vanguard. We have a Vanguard's donor advised fund. which is great. You can donate appreciated stock or ETFs or mutual funds. It doesn't trigger capital gains, and you can deduct the current value of whatever you donate, and you can deduct it immediately. In the year you contributed to any donor-advised fund, we use Vanguard. But you don't have to actually give the money to a charity at the same time. It goes into a fund. You control how it's invested. Obviously, with Vanguard, it's Vanguard funds. And then you can give it out, periodically, which is what we do. And so I have sold, or donated Apple stock in the past, and I'll probably do that again. But in any event, yeah, I'm not selling my shares right now. I think everything is overvalued. I mean, if you look at like a PE, let me pull this up. Apple is probably, I don't know, around 30? I'm not even sure. Well, that's right. Morningstar uses a forward PE, which I'm not a huge fan of, but it's at 27. Just to put that in perspective, Tesla what's their forward PE? 101. That's cheap for Tesla. Holy cow. Anyway, so yeah, I'm not really looking to sell it. I would take a huge tax hit. That wouldn't keep me from selling it. I mean, I don't know what price or what valuation would force me or cause me to sell it or donate it, but we're not there yet. By the way, that doesn't mean it won't go down. It could go down a lot, and it has gone down many times since I've owned it. I bought it in 2013, bought again in 2018 and 2019. Tommy, hello Rob, greetings from Utah. Been to Salt Lake once. Great videos. Can you make a video on a backdoor Roth? Sure. The basics of a backdoor Roth are, if you make too much money to contribute to a Roth, and maybe you make too much to deduct contributions to a traditional IRA, you can open up and contribute to a traditional IRA. You won't get the deduction, right, because you make too much. Whether you can deduct it or not depends on more than just that. And then you before it has time to have any gains, you immediately convert it to a Roth IRA. You've already effectively paid the taxes on it, and now it's in a Roth. And you say, well, wait a minute, Rob, that's the dumbest thing I've ever heard of. Why would the government not allow you to contribute directly to a Roth IRA, but allow you to contribute to a traditional IRA and then immediately convert it into a Roth? It's a great question. And when they first created the Roth IRA, they didn't want rich people making more than whatever their income limit was, getting the benefit of this. Which I think is kind of silly because, and this is a whole nother story, but assuming constant tax rates, there's really no difference between a traditional and a Roth. It's more complicated than that, but more or less that's correct. But they were passing a law, I forget what year this was, and they needed to generate extra income to pass all of the budget metrics that they have to meet in order to pass a law. So they had to come up with a way to generate more revenue, so they allowed the backdoor Roth because it triggered normally, not the backdoor Roth, they allowed Roth conversions regardless of your income. And in many cases, that triggers taxes. So if you've had a traditional IRA and it's sat there for a long time, it's got all these gains in it, and then you convert it, it's going to trigger taxes. But the idea of a backdoor Roth is you convert it right away before it has time to earn anything. And then you allow all the earnings to occur in a Roth. The one thing to keep in mind, though, is that the IRS looks at all of your IRAs together. So if you've got a traditional IRA over here with $1 million in it, congratulations, by the way, and you think, well, I want to do a backdoor, so I'm going to open up a new one, just put the $6,000 in it, and I'll just convert this one over here to a Roth. The government's going to look at both of these together, and you're going to end up getting taxed. And they do it as a ratio and all that stuff. But I can do a whole video on that. That was probably just a confusing mumbo jumbo. Ethan says, Rob, you reference Bingen, but the FI community always references the Trinity study. Are there any differences or reasons you don't talk about the Trinity study? Not really, other than, Bingen was first, so he gets the credit. The Trinity study is a little different. They actually look at one set of scenarios where you're not adjusting for inflation. You're just taking out a percentage every year. But no, the Trinity study is good. I think it was published in, I want to say 98, but I could have that wrong. And I've read it. I mean, it's been a little while, but it's a good study. Is it okay if we entered the markets on, I don't know what that is. I learned so much from you guys. I have no idea what that is. Is it ticker ATH? I'm not sure. I'll have to look at that. DJ SCRA 89. Hey Rob, greetings from Tarpon Springs, Florida. Love the channel and the books. Thank you. Born Again Bride writes, any legitimacy to the supercharged Roth strategy that uses deductions somehow to lower the tax burden using laws in the 2017 Jobs Act? I don't know. I'm going to have to research that one. I have no earthly idea. I'm making a note. Supercharged Roth strategy uses deductions in the 2017 Jobs Act. I'll get back to you on that one. Mike retired, says, hey Rob, always enjoy your content. We gift your book to everyone and anyone. When is the next book coming? Well, first of all, thank you. That means a lot to me. I've actually started working on the next book, which is going to, if you guys have listened to me for a long time, I'm just going to be honest with you. There probably won't be anything new in the book. But the basic idea is a book that's, Retired Before Mom and Dad was not just about investing. It was sort of more of a philosophy, a way to think about money and how to handle money. The next book is just going to be on investing, and it's going to be, basic how to invest and how to build wealth, investing in index funds. And it's going to be designed for the beginner, but I'll get into some more advanced topics in it, and I'm working on it now. There's part of me that I think I'm going to try to just plow through it and have it available by the end of the year. And then my next one is going to be how to invest in retirement. Once you're retired, how do you invest? Which gets into all the things we talk about on this channel a lot. How much can you spend, the different ways to withdraw your money, guardrails, all these issues about Social Security. Should you annuitize part of your portfolio? That book will take more time. That one's much more complicated. Investing, until you retire, investing's easy. We make it hard. But it ain't. But once you're in retirement, it gets more complicated. Scott has an interesting approach. He's 64 and retired. He says, half my portfolio is in cash. It's a lot of cash. The other half in a balanced portfolio. He lists some Vanguard funds. The cash will be drawn down in the first 10 years, leaving the balanced portfolio to compound. Well, it'll be interesting to see how that goes. For me, half my portfolio in cash is just a lot of cash. All right. Saban says, if I'm 24 years old, why should I be paying Social Security when I won't have any benefits at 65? Well, there's two reasons. One, because it's the law, and if you tried to skirt it, you'd get in trouble. I'm a lawyer, so that's what I'm a retired lawyer, recovering lawyer. Anyway, I think there will be benefits. I said that earlier. That's my opinion. I could be wrong. Mark, morning, Rob. First time to be able to join live. Thanks for your channel. I continue to learn a lot from your videos. Thank you. Welcome. All right. What else we got? Vinyl, you're just causing trouble today. You're beginning to come around to the dividend growth model. If you're rich enough, you never have to sell any stock. Or if you're frugal enough. I like dividends. They're just not free. And they're not better. I like all my returns. So WBED11 says, hi Rob, I hope your channel grows to way more than 22,000 subscribers. So first thing, I'm thrilled with 22,000 subscribers. Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. I'm going to try to stop that. Here we go. But yes, I hope it grows. What am I at now? 22,097. All right. Jonathan, would you make any recommendations to invest in QQQ as an additional third fund if you're aiming for a two-fund portfolio with VTI and VXUS? I mean, again, I think you can take some portion of your portfolio, I don't know if it's 5 or 10% or whatever, and kind of go beyond the market as a whole. I do it with individual stocks, so I have less interest in doing it with factor investing or something like that. With QQQ, just the thing the thing I would be questioning is, am I wanting to go to QQQ because of its recent past performance? Because it will take a beating, I guarantee it. I just don't know when. I know you'd like to know when, wouldn't you? So would I. I don't know when. It will take a beating, and it may take a beating for years. Will you stick with it? That's the question. I mean, the thing is, VTI can take a beating, right? But the more you're simply modeling the market, then you don't have the worry of I've screwed up somehow. I've gone down a certain sort of narrow path, whether it's small cap value or emerging markets or QQQ or some covered call ETF, and that might have been a mistake. So because unless everything just completely falls apart in the world as we know it, if you're modeling the market, you're going to have good years and bad, long term, probably good. Yes, there are no guarantees, but it's not going to be because you chose a bet on a fairly narrow sector or whatever and it didn't work out. So some percentage in that is fine. I just, like, even with my individual stocks, always check myself. Say, okay, well, if these just all went to zero, would I be okay? And the answer is yeah, I'd be okay. I wouldn't be happy. Might take a day off from YouTubing, but this is an interesting question. Vinyl keeps coming up with good ones. Would you take Social Security age 62 if you want to lower your retirement income to keep under the $200,000 Medicare tax or $163,000 IRMAA line? I don't know is the answer to that. I would have to model it or have someone model it for me. And I also have to look at the taxation of the Social Security benefits. It's a good question, but I just don't know. I'd probably pay someone to model that for me, like my tax accountant. For an employed 18-year-old, this is from Fred, wanting to open a Roth IRA and dollar cost average, what ETFs would you recommend? Well, first of all, Fred, welcome, and I'm thrilled that at age 18 you're thinking about these questions. Because certainly unlike me, and I'm going to guess unlike most people watching this live, you have one advantage, and that is you're young. The biggest thing you got going for you are decades of compounding. So I think, again, the 3-fund portfolio I think is perfect if you're just starting out. It's got some bonds in it. I did a video on the Roth IRA just yesterday, so you check that video out. That's the answer to your question. I like to put bonds in traditional retirement accounts if you have them. If you don't, that's fine. But the 3-fund portfolio, if you're just starting out, you could even just put it in stocks to begin with. If I were 18 starting today, I'd probably start. Let's say I'm putting $100 a month, $250, whatever the number is. Honestly, I'd probably start by just putting it in an S&P 500, and I'd do it today, even though the S&P 500 is richly valued. It will come down, but that's okay. I'm 18. I hope it crashes, actually, because then I can buy it even lower and lower prices. And I'd probably start at just an S&P 500. I'd keep learning, keep reading, listen to other people, but form my own opinions. And as you build up more and more money, then you might diversify into international funds or whatever you decide. So that's a way to go. But the 3-fund portfolio, I think, is kind of the starting point. Again, if you're just starting out, $100 a month or whatever, you could do the 3-fund portfolio. You could just do an S&P 500, recognizing that it's going to be a wild ride, but all right, what else we got? Fast Eddie wants to know about the barbell withdrawal method, which I'm vaguely familiar with, but I'm gonna add that to my list of videos so I can do more research. How do you, this is from OC6 HUKI. How do you enter a federal pension into personal capital? I need to model retirement for my wife and I when she is 12 years older than I. Any tips for couples with an age difference? Yeah, I mean, let me see if I can pull this back up. So, we go back to the retirement planner. You can, in income events, you can create like pension income. The amount, whether it's before taxes, every year, and at what age will it start? So like if your wife's going to get, I don't know, $1,000 before taxes every, I guess I'll make it 12,000. I was thinking 1,000 a month, but we'll do 12,000 every year, and it's going to start when she's whatever 67 or whatever. You know, you could do that. And let me come back down. This only has me in it, but you know, you can add children, right? But you can also, if I were married, well, I am married, but I'm not modeling my family in this demo version. You can put your spouse and her or his date of birth and so on, how you file your taxes. So, and once you have that in there, you can model in income events. If you each have a pension, you could put 2 of these in and start them at different time periods. So that should, I think that should work. All right. Charles from Michigan, good morning. Go Buckeyes. We didn't really play that well. I liked our quarterback, but it was kind of a rough game. So Dave, he asked us this question about dividends versus capital gains. He says, my question was on the tax rate of dividends versus capital gains. Well, so assuming, if we assume that they're qualified dividends, I think most dividends are, and if we assume that you're selling an investment for capital gains that you've held for at least a year, then at the federal level, they're both treated as long-term capital gains. So they're taxed the same. Dividends that aren't qualified, I think get taxed as ordinary income, as do capital gains that were triggered from the sale of an asset you held for under a year, short-term capital gains. All right. Why must I go says long-term VOO. By the way, I just learned that VOO is the Roman numeral for 500. I haven't confirmed that, but that's what I heard. Outperforms VTI. I do my research. Well, I'm curious what period you looked at. And that certainly recently, that would be true. I looked at it and it wasn't much of a difference. But it may have outperformed, but if it did, it wasn't by much, at least in the periods I was looking at. So Jennifer says, is it true that a wife whose future Social Security benefit will be less than half of her husband's should take her Social Security at 62? Jennifer, the short answer is I don't know. But I do believe that in that scenario, she should take it sooner. I don't know if it's at 62, and that's why I say I'd just pay someone to model it. Or there could be, I'll make a note to find some Social Security calculators and can maybe share them. Next week. Okay. All right. What else we got? Ron from Chalfont, Pennsylvania, Bucks County. Go Irish. Welcome. All right. Let's be nice in the chat. So you realize I'm working through the chat, and I'm probably at least 5 or 10 minutes behind you guys. So I come across things. It's like the Saturday Night Live skit where I laugh 30 seconds after the joke was told, which actually is pretty much what I do. I'm a little slow. All right. Alexandra says, hello, I took an investment loan, leverage, in March 2020 with a bank. The interest rate is 2.7%. The problem is that the bank forces me to have it in mutual funds with 2 to 3% in fees. Yeah, that's not a good deal. My investment has doubled. Oh, congratulations. What would be the fiscal impact if I decided to sell half to buy a low-cost ETF? Do you think it would still be worth selling despite the tax impact? Well, boy, there's so much in that. First of all, I would never invest on margin or leverage. And I wouldn't invest in mutual funds that charge 2 to 3%. So I would figure out how to get out of all of that. But how you're going to do it is going to depend on the tax implications of your decisions. Do you do it all at once? Do you spread it out over this year and next? And I would talk to a tax pro to figure that out. But I certainly, I've never invested on margin. I don't think it's a good idea. And I don't think investing in mutual funds at 2 to 3% is a good idea. And it sounds like you don't either. I guess you're trying to figure out how to get out of it, and I hear you. But I think you're going to need to talk to a tax person. So Todd asks a good question. When rolling money from Roth 401k to Roth IRA, and both accounts have been open for more than 5 years, does the 5-year conversion rule apply to those funds? So Todd, unburdened by any research on this issue, I don't believe it does, but because it's not a conversion, right? I believe the conversion rule kicks in when you go from traditional to Roth. This is a rollover. And if they've both been open more than 5 years, and if you're rolling into the Roth IRA, I think what really matters is whether the Roth IRA or any Roth IRA that you own has been open for more than 5 years. I think if it has, I think you're okay. But that's, I'm just a guy on YouTube, so, you'll want to confirm that, but that's my belief. All right. Vinyl says, I don't believe share buybacks have any effect unless it is a negative one. Really? I mean, if the share buybacks are made at reasonable prices, it's a great way, I think, for a company to use its capital. I mean, assuming it doesn't have better investment opportunities. I mean, if you look at, I was going to do the math on my percentage ownership of Apple as it's gone up because of their share buybacks, and therefore I get more of the dividend. And I mean, it's just all good. But the assumption is the buybacks are occurring at reasonable prices. That's a big assumption. All right. What else we got? So Alan says, a company paying a dividend is not permanently impaired by paying the dividend. Well, assuming they're not being irresponsible, I agree with that. I don't think they're permanently. I mean, Apple is not permanently impaired because it pays a dividend. Its balance sheet goes down. I mean, between dividends and buybacks, it's spending $85 billion a year. I mean, that, and if they're going to retire the shares they're buying back, I mean, I think it could be good for investors. It could be a really smart thing for the company to do, both of them. But it's affecting their net worth. It's no different than if you owned your own company. You owned a dry cleaner. It's worth $10 million, and you paid yourself $1 million dividend. It ain't worth $10 million anymore. Jonathan says, I like Jack Bogle's advice. Diversification is good to my mind. All right, what else we got? Born Again Bride, great videos. Thank you. Hailing from Folly Beach, South Carolina, and Venice, Florida. Those sound like two really nice places. So Tommy Lee says, Rob, economists warn that Social Security could be insolvent within 8 to 12 years. Whether that turns out true or not, what proactive actions do you recommend for the average Joe to do now? Well, first of all, I mean, they've been predicting that for decades, all right, for Medicare too. And Social Security running insolvent doesn't mean that checks will stop coming out. That's the beauty of our government. They can just keep printing money. So to me, as I said, from a planning perspective, I don't count on Social Security, but I do believe it'll still be there. And if you're in retirement, I think the odds of Social Security going away are very, very small. But beyond that, you could figure out how would you survive without it and do your best. Adjust your spending accordingly if you can. Think hard and long about any debt you take on. But personally, I just don't see it going away. Alan says, I have studies that show that 70% of 4 to 8% yielders, those are companies whose dividend yield is 4 to 8%, recover the ex-dividend gap, meaning the decrease in price effectively when they pay the dividend, well, kind of, within 5 days. Yeah, that may be, I don't know, but I'm telling you, their intrinsic value goes down, and intrinsic value in the long term is what matters, not what happens in 5 days. That's my opinion. Well, everything is my opinion on this show. Akeem says, Rob, what are your thoughts on this portfolio? VTI, 25%. That's right, total stock market. VU, 30%. Let me just stop there. I don't know why you'd have both. I mean, you could. I don't think that's like some glaring mistake. But the overlap, there's a huge overlap. Doesn't seem like there'd be a big overlap. VU has 500 companies. VTI has, I'm going to say 3,500. I don't know. We'll call it 3,500. But they're cap weighted. So most of the investment goes into the largest companies in both of those funds. And so they're almost identical from a performance and risk perspective. Yeah, it has 39. VTI has 3,900 equities. VNQ 5%, VXUS International 5%, TIPS 20%, VGLT. Overall, this looks like a good portfolio to me. I have that one question. Let me make sure I know what these tickers are. Yeah, VNQ is real estate, because I have that. I just don't have the REIT version. The ETF version. VNQ, a good fund. VXUS 5%. I think that's fine. TIPS, 20%. VGLT is that growth? Oh no, it's just, so the long-term treasury is interesting. The one thing about long-term treasury is rates are so low, you could take a beating. Of course, they could go lower and you can make a fortune. The duration of that fund, I want to say, I'll show you, I think it's 15 years. 18 years. So if it goes up 1%, the fund loses 18%. Of course, if it goes down 1%, you earn 18%. So that's just keep that in mind. It's awfully expensive right now. But you have 20% in tips, which offsets it a bit in a way. And then you 5% in emerging markets. That seems overall like a pretty good portfolio to me. Leslie says, from Arizona, just wanted to say thank you for the very informative videos. You're more than welcome. Let's see. Marx asks, for someone in their upper 30s or lower 40s, what percent of estimated Social Security would you recommend using in expected income when planning for retirement? Well, I would probably use 0 just because I'm super conservative, right? Plan for the worst, hope for the best. That's what I would do. You could run a couple different scenarios, but you're still pretty young. So there's a lot of crap is going to happen between now and when you reach Social Security. Think back 30, 40 years in the past. We've been through a lot as a country, in the world. There's going to be a lot happen between now and then. So many more things. My hunch would be that so many more things will affect your retirement readiness beyond Social Security. I wouldn't lose any sleep over what you pick. Oh, here's a good question from Chris. Rob, I'm 45 and I contribute to my 401k and max it out, and I put in $6,000 into the Roth IRA. What would be my next move on where to put money? Well, your next move would be to sit back, relax, and enjoy the ride, because that's phenomenal. Yeah, so there's a couple of options. Of course, taxable account for most people. If you have an HSA, I'd max that out. If you have a 401k that allows you to put in additional money, right? It's after tax, particularly if you can then convert it into a Roth right away. Most plans, in my experience, don't offer that, but some do. So you could find out. That would be another option as well. Those are the ones that come to mind. What some will sell you on are insurance products at this point, and I wouldn't bother with them. All right, once again, I'll say, everybody be nice to each other. It's just investing. It's not life or death. Okay, it's kind of important. All right. Try to keep politics out of the chat if we can. I know politics do affect investing, no doubt about it. But I see, like I said, I'm behind you guys. So now you're talking about the policy in China, the 3 hours of gameplay. What else we got here? Yeah, the whole strategy called buy, borrow, and die. You'll see a lot of that in the Reddit community that I follow called Fat Fire. I'm just not a big fan of it. The basic idea is, let's say you've got 25 million bucks. You open up an account at Schwab or somewhere that has a very low rate on borrowing. So rather than selling your investments and triggering taxes, right, you borrow. And you borrow at a very low rate, and it's a relatively small amount compared to your wealth. And you just keep rolling the loans over. It's such a small amount that you're not going to get a margin call, because even if stocks go down by half, you've got so much and the loan is relatively small. And you just keep borrowing. And then eventually you just die. And then your estate deals with it. I don't know. I just like to keep things simple. But, if you're interested in it, just Google buy, borrow, and die. There's a lot of content. Maybe I'll do, I don't know. Maybe I'll do a video on it. Taking another note. I think I've just accumulated all this useless information in my head. What else? Dan says, I look forward to the retirement book. I'm retiring on 9/30 at age 58. Congrats. That's got to feel good. Trap Cracker says, reading, I like that name. Reading your book now and loving it. Thank you. Any source for learning the qualified versus non-qualified dividends in an international fund? That is a great question, and I don't know the answer off the top of my head. Taking another note. I'll try to figure that out. All right. Frank says, thanks for getting me through my last hour of intermittent fasting. Have a great day. That's what I'm here for, man, helping everyone get through that intermittent fasting. That's a topic I've thought about talking about, not so much intermittent fasting, but, it's kind of a retirement show, right? And so much, we talk about money, but there's, keeping fit. I do a lot of things that I don't talk about on this channel, of course, to stay fit. I cycled 40 miles yesterday. I've got a gym in my garage with a rack and bumper plates and kettlebells and TRX and pull-up bar. And I work out, I lift, if I'm not traveling or something, lift 3 days a week, cycle once to two times a week. When I'm not cycling, I tend to walk 3 to 5 miles a day. And then there's the whole mental, fitness. And hopefully I'm not losing it. But for me, all of this helps. And then chess. I play chess. So you got to do something to stay as sharp as you can. I guess I could get my hair colored. Maybe that would make me look younger. I don't know. Anyway. Oh, this is an interesting question. Michael asks, is there a guidance on when one, and age 45, for example, might say, okay, I got enough in my retirement accounts, just let the compounding do the thing. And instead of maxing it out, divert investments to a taxable brokerage account. Well, so first of all, there's a concept called coast fire. Fire is financial independence retire early. Coast is, you get enough money invested, and now you can just leave it there and let it do its thing, and you're going to coast into fire 5, 10, 15 years later, depending on your career goals, how you want to live your life, whatever. So you could Google that. Yours is a little different because you still want to use the money to invest. You just want to do it in a taxable brokerage account. And my question to you would be why? Right? Why do you want to give up the tax benefits? Do you want to use the money soon? Maybe that's it. You want to use the money sooner. But that would be my thinking. Why do you want to do that? If you want to use the money, in the next 5 years, that may make sense. I mean, there are ways to get money out of a retirement account before you're 59 and a half without the penalty, but all right. Andy asked a question that I don't even know. I'm going to have to research it. You guys are asking tough ones today. He says, hey, Rob, great content as always. What are your thoughts on big ERN's inverse CAPE methodology as a SWR, safe withdrawal rate? No idea. But I'll have an idea. All right. WBed11 says, I learned a lot from your discussions of beta, the Sharpe ratio, etc. Thank you, sir. You're more than welcome. By the way, I do almost nothing with those ratios for my own investing. I mean, an index fund, if you're 3 fund or 6 fund, you don't really need them. I don't use them to evaluate stocks. Yeah. So Kevin says, D is the Roman numeral for 500. I'm really bummed. All right. So Andy says, Rob, great channel. How would you recommend someone who is 62 with 401k under 6 figures to save more for retirement? Delay Social Security to 70. Well, I mean, how do you save more for retirement? You make more and you spend less. I mean, I know that's probably not a helpful answer, but I would literally scrub every expense that I have. I'm not someone who, I don't describe myself as frugal. But I would look at everything that I spend, and I would be asking some serious questions about it. I'd consider everything from getting rid of a car to moving to, all of these things. I write about this in my book. If I suggest to someone, well, get rid of one of your cars, and this would be true for me as well, the initial reaction is, oh, I can't do that. You just immediately dismiss it. And I recommend that you actually seriously give some thought to these crazy ideas. You may end up rejecting it, but I think we should ask what if. Well, what if we only had 1 car? Or for some of you, what if you only had 2? Because cars cost a fortune. I mean, beyond a house, but house appreciates. Cars are the biggest expense of any, of just about anything we have. But, I don't have a better answer for you. I mean, that's what you need to do. I think expenses can be somewhat easier to control over making more. But, that's it. In terms of delaying Social Security for 70, I mean, it depends. Can you get from 62 to 70 without your Social Security? If you can, then it might make sense. But again, I'd still have someone run the numbers for me. Chris Liu, I guess. Just started learning about investing. This channel has been fantastic. Thank you for all you do, Rob. You're welcome. I'm going to have to call it a day in about 8 minutes. I'll get through as many of these as I can. Jeff asked an interesting question. My wife has a teacher's pension. She took time off to raise our kids. Is it worth using her 403B to buy back a few years of the pension she missed? Again, there's no way to answer that, and just, you just have to run the numbers, and you might want to pay, a financial advisor for an hour of his or her time to help you do that. I know some teachers that have done that. I think, in fact, the very same situation you've described. But it's just going to depend on what you get. Alan says, no new chess problem? Oh, well, come on. I can give you a chess problem. So I'm going to show you guys real quick, and I know this isn't a chess channel, but chess.com, they have a thing called Puzzle Rush. So if you know how the pieces move at all, this is a great, we're talking about keeping your mind sharp. Puzzle Rush, I'll just play it for a second just to show you. You can do 5 or 3 minutes, but it gives you these puzzles, and you've got to solve them as quickly as possible, right? And so the answer here is that. And you have 5 minutes to solve, as many as you possibly can. I don't even know what the answer to this one is. Well, here we go. And you'll get better over time, but it's a great way to just try to stay sharp. You know what I mean? So that's one. But anyway, I'll quit this. My high score, I think, is 34 in 5 minutes. The puzzles get harder and harder. Boop. All right, I'm done. But I will come back to puzzles. There you go. That's a hard one to solve. I'll let you look at it while I go back to the comments. All right. Mike asks, do you keep personal capital and e-money up to date with your accounts? Well, the short answer is yes, because it's done automatically. He says, we also use Plan Vision, which is Mark Zorrell's company, and Mark's a friend of mine. I use him. We talk once a year. I think he's great. I have no financial relationship with Plan Vision at all. Anyway, he says, we also use Plan Vision to keep both up to date for investments. For spend, we use YNAB. And by the way, hi from Santa Barbara. I love Santa Barbara, beautiful place. And one of the best TV shows ever was from Santa Barbara. Did they actually film in Santa Barbara? It looked like it. Anyway, YNAB is great for budgeting. I like YNAB a lot. Jesse's the founder. I've interviewed Jesse. He won a pull-up competition at FinCon one year. I've really kind of grown to like Tiller, but YNAB is great. Red Robin says, just passed the CPA exam in California. Congrats, because that ain't easy. Much harder than the bar exam. All right, well, I got to, unfortunately, wrap this up today. I want to try to spend 2 hours every Thursday, but I can't today. So I appreciate everyone joining. I'm going to scroll down to the bottom. Does anyone have an answer to the chess puzzle? I haven't even looked at it. These are hard, by the way. These are much harder than what we were looking at just a second ago. I have no earthly idea. Well, so I think my current thought is queen here. The idea is the bishop's pinned, and I'm threatening mate in 1 by queen takes bishop. And I think the only way for white to get out of it is to take the knight with the queen. But then I can take the rook, check. Either the bishop interposes or the king moves, and then I can take the queen back. And I end up with a queen versus a rook and a bishop. That's my guess. We'll find out if I'm right. Yay! One for the good guys. All right, well, there you go. Appreciate everyone who joined. I have a lot of fun doing this. You guys are terrific. I learn a lot. You've given me homework. You've asked me questions that I either don't know anything about or know a little, but want to look at it more before I opine on it. So I will be doing that, and appreciate it. So hope you all have a great day. Until next time, remember, the best thing money can buy is financial freedom.